Hey guys, welcome. Todd Sachs of Sachs Realty, and welcome to another Tuesday night podcast. And we are live again. And we kind of like this live aspect. We started out doing it live, and then we kind of backed off because we were having internet connectivity issues and things like that with some of our guests, even myself. But we've been back doing them live again, and it's kind of fun. We like the interaction. Tonight, we're going to talk about investor loans. This is really big. A lot of what we do here at Sachs Realty is we work with investors and people that want to flip houses and invest in rentals and commercial properties. And tonight we have Kevin Hill with Aloha Capital, and he's coming from Colorado. So he's a couple hours back. And I was just saying how, I'm getting ready for bed and he's just getting ready to get off work. But guys, I'm Todd Sachs. I'm the broker and founder of Sachs Realty. We're a real estate brokerage here in Maryland, and we help buyers and sellers and tenants of both residential and commercial real estate. We bring this Tuesday night podcast to everyone all around the country. We actually help people all around the country through our amazing broker network. So if you're listening and you need some assistance in a state that's not Maryland, make sure you reach out. All of our information will be in the show notes. Kevin is actually a client of mine. I was introduced to him to sell some properties for them. And we've had, over the last 5 or 6 months, we've had some great interaction. And these guys are really talented. They are great private money lenders. But tonight we're going to talk about that. How do you borrow money? What are investor loans? What's the difference between hard money, private money, bank loans on the commercial side of things, and even residential up to 4 units. But without further ado, I want to introduce Mr. Kevin Hill. He's the COO of Aloha Capital. Kevin, thanks so much for joining us tonight, and kind of give everybody kind of like a high level view of you and Aloha Capital.
Yeah, thanks, Todd. Thanks for the welcome. Aloha Capital is a private lender. We are primarily focused on real estate investors. So we're providing bridge and permanent financing to fix and flip, fix to hold, single family and multifamily properties across the country. We've been doing it since 2015. We've done almost 2,000 loans since 2015. We're on track in 2021 to do 200 million in loans this year. So we're seeing a lot of deals come across our plate across the country.
Can you kind of explain the difference between what you do? I mean, private lending and hard money. I mean, there's a difference between the two, right? I mean, you guys don't really consider yourselves hard money lenders, or do you?
Yeah, I'll do my best to answer that. I would say different people define those things differently, but I would generally say a hard money lender historically has been a group that lends 100% on the asset, on the property. And they don't care who the borrower is, what their experience is, what their financial stability is, credit score, anything like that. With that outlook, those loans typically look like 12 to 14% interest, 3 points. So the hard money is that it's hard to swallow. It's very high interest rate. So that's my perspective of it. I like to refer to us as a private lender. Now, some people call private lender a private individual that is lending, their own personal wealth. Where we are a little bit different is we run an investment fund and we have institutional backing. And so I would kind of put us in the spectrum between a bank and a hard money lender. We definitely are not a bank in any way. But from a rate perspective, we're doing loans kind of in the 7, 8, 9, 10% interest rate range versus that higher tier of hard money.
So can you lend in all 50 states?
We could if we wanted to. I would say we lend in about 44 states. So the places we don't lend are our decision. Really it's because we don't necessarily want our capital allocated there. So the Dakotas, Alaska, a couple other states where we just don't feel like there's enough transactions happening there. So the asset's not liquid enough for us.
So did you say you're going to close, or you're predicting to close 200 million in the next year? Is that what you said? 200 million. And give us some kind of idea on, where your bread and butter is. So, are these $500,000 loans borrowers, or these, $150,000 borrowers?
Yeah, really good question. I would say we do it all. We started in 2015 really serving kind of the rental markets across the country. So our typical clients were buying $40,000 to $60,000 properties, putting 20 to 30,000 into them. They would be worth somewhere in the $100,000 to $120,000 range. So there's a pretty small loan sizes, somewhere around 75,000 was our average back then. We've expanded our capabilities in the states we lend into. So, different markets. We're in Boulder, Colorado. The Denver market's pretty hot. There's, plenty of houses that are getting, $600,000 purchase, $300,000 into it, and the properties are worth 1.2, 1.3 afterwards. So, as far as what our range is, we have, a single family bridge lending program that can have a loan size of 75,000 to 2 million. And we also do value add multifamily lending, where the ranges, the loan size would be 500,000 to 10 million. And so, we aren't necessarily turning down any deals within those ranges.
So do you have a per borrower limit? I know a lot of banks, small banks that do, commercial lending, and first let's kind of define commercial lending. So, because a lot of times people say commercial lending is anything that you're not living in, depending on the bank. So if it's a non-owner occupied, it could, for that bank, even a single family house could be technically a commercial loan for that bank to lend you the money. But typically speaking, a commercial loan, we're talking about multifamily over 4 units. So when you really kind of step into, and I guess depending, right, Kevin? I mean, is that how you guys look at it? Anything over 4?
Yeah, I mean, I would say, the commercial definition can be used in 2 ways. The loan, the way it's structured, if the borrower is, or the asset is not an owner-occupied property, typically then the borrower and the owner of that property might be an LLC or some type of entity. That's considered a commercial loan or business-to-business loan. And then the other side of it would be a commercial property is typically something that's 5 or more units or mixed use.
Right.
And what Aloha focuses in is non-owner occupied business-to-business loans. So we cannot do, and we will not do, a loan to an owner-occupied residence, and we highly prefer that the borrower is an entity, just to kind of solidify that it is a commercial loan, and we fall outside of the compliance and regulations related to consumer loans. And
you do long-term loans. Do you do 30-year loans?
We do. We have a loan program for 1 to 4 units, condos and townhomes. It's a 30-year fixed amortizing loan on non-owner occupied properties, so on rental properties.
Yeah, that's amazing that you actually do 30-year for LLCs. I mean, a lot of banks are they'll amortize it, and we'll get into a lot of these terms, but they'll amortize it over like a 25-year period, but you're going to have a balloon period, or it's going to, the rates could readjust. You might have a lock-in for like 5 years, and then at the end of that 5-year term, your rates are adjusting, but you're not really getting a 30-year loan. And we'll kind of talk about that a little bit. And guys, if you have questions, so Kevin Hill with Aloha Capital, if you're just logging on, if you guys have your borrowing questions, you want to get into real estate investing, or you're a real estate investor and you have questions, go ahead and comment those during this podcast, and we'll try and answer them for you while Kevin is on the line. Kevin, being in Colorado and lending all over the country, 40 states plus or minus, what kind of time frame? I mean, how long does it take to get a loan funded through you guys? I mean, we're in Maryland. If we have a client here that puts in an application, I mean, how long does it take to go through the underwriting process to be able to close?
Sure. On all of our loans, we do an appraisal or some type of valuation. And so really that is the part that can take some time, but we've created some solutions to streamline that. As you all know, right now, there's a bit of a supply demand issue with appraisers. So we've moved into the ability to do a hybrid appraisal, which is, sending an inspector through the home, and then it's a desktop appraisal by a local appraiser. So those can get done in 5 to 7 business days versus what we're seeing kind of the 20 to 30 days that it's taking for a standard appraisal to happen. I bring up the appraisal process because we do want to have an appraisal in hand before we close on the loan. But we typically close 1, 2, 3 days after we receive the appraisal report. So that is the big thing in our world that we provide is speed. Where a bank might have an appraisal in the underwriting team's hands for weeks before they're ready to close.
Sometimes a bank has a loan committee meeting once a month, or once every 2 weeks. So it has to go to committee, and then a whole bunch of other stuff has to happen before they'll even, really get the ball rolling.
I would say to further answer that question, if we can use that hybrid appraisal and it comes back in 5 days, while we're waiting for that appraisal to come back, we do have an underwriting process where we're looking at the borrower's experience, their liquidity, their FICO score, and background check. That's really what our borrower underwrite is. And so we can do that in as quickly as the borrower is willing to respond to a few questions. So it's not typically Aloha slowing down the process. It's typically, us collecting that information from the borrower. And when I say borrower, because our borrowers are entities, and we should really dive into what that means. And
yeah, that's important.
Cool. We might be underwriting, we underwrite 51% of the entity. So depending on the makeup of the membership, that might be 1 or 2 people, could be 5. But we underwrite 51%, which means we pull a credit report, a background check, and as the entire group, we're looking for their experience and the liquidity. And on the liquidity side, we're just making sure that they have money for down payment, they have enough money for 6 months of interest, and they have some money to cover the portion of the construction costs. And we can dive into why we look at that.
Let's talk about the business aspect that you finance LLCs or corporations, because that's huge. There are not a lot of banks that will do that. I know actually very few. They want it to be in the personal borrower's name, and then maybe there's a way that you can transfer that out and pay more and transfer costs and things like that, recording fees. But talk about, why is it that you finance LLCs and other banks won't?
Sure. Well, the main thing is, we're providing business to business loans. So, we can do a loan to an individual, actually, as long as they're verifying that's a non-owner occupied property. But there's a lot of benefits to the real estate investor to own a property in LLC. One, it allows you to raise capital from partners and streamline that through a single entity. And 2, you get and I can't provide any legal advice, of course, but it provides you liability protection if anything happens within the property while you own it, from your personal liability. So those reasons, it's great to own a property in an LLC. And then for us, it really helps from an underwriting perspective. One of the things we work with is a wide range of real estate investor clients. So We work with people that have never done a deal before, and we work with developers who have built, ground up developments, infill, suburban developments, very experienced real estate investors. So on the less experienced side, we can offer a loan to someone that has no experience, but the leverage and rates we offer depend mostly on experience. And so you can get from us and from our competition, typically you can get better leverage, so more higher loan sizes and lower rates if you can show some similar relevant experience. And so within an LLC, the way to do that is maybe the person who's new is the primary real estate investor, and they want to bring in maybe a friend who has done a couple transactions before. So all we need is that person that has experience to own 10% of the LLC to qualify their experience in the deal. And remember, if you're not familiar with an LLC, there's a couple things to know. Your membership percentage does not need to align with the profit allocation, and that does not need to align with how much money each person brings to the deal. So there's ultimate flexibility there for structuring a partnership, a joint venture with other real estate investors.
So give us like an example of a new investor that comes to you, they set up an LLC, they buy the property in that LLC, and it's under contract, and they want to borrow money. And give us kind of like a real scenario of someone in $100,000 range. I mean, if you can think of one of these recent deals you've done, just kind of that is a newbie, kind of walk them down that process.
Sure. I mean, I think the first thing they want to know is how much money do they need to come up with to get this deal done? I mean, that's typically the first question. So for a newbie, someone that does not have any relevant experience, we would do 80% of their purchase price. So let's say that's $100,000 purchase price. We're covering $80,000. We then cover 100% of the construction costs. So let's just say the budget was $20,000. So we're covering 80% of the $100,000 purchase. So that's $80,000. We're covering $20,000 of the renovation budget. So now our loan's $100,000. And so, typically on that transaction, the after repair value, or sometimes the acronym ARV, would typically be somewhere around $140,000-ish. So we want to keep our loan below 70% of the after repair value.
Mm-hmm.
So we look at the loan in two ways. We look at the uses. So we're going to cover max, in this case, 80% of the purchase and 100% of the renovation, but we need to keep our loan under 70% of that after repair value.
Right. So if it's at least 140,000, you would finance up to 98,000. So basically we're there, right?
Yeah.
$100,000 property. Yeah.
Yes. Yeah, so we would finance 98 in that case instead of 100, because that's right, kind of maxing out on the after repair value.
Right. So who determines the after repair value? Is that the appraiser that you hire?
Yeah. So when we get an appraisal, we actually get, on a single family home, we would get a 1004, which is the format that the appraiser puts the appraisal in, and it will actually have an as is value and an as complete value. And it will have 3 comps and a comp map in the report. So what we do is when we provide terms initially to a borrower, we're asking them to estimate the after repair value. We have our own internal tools to get a quick analysis of what we think it is, but in the end, we're relying on what the appraisal shows. So it's always good for a new investor to really, pull some comps on what you think that property is going to look like after you complete it, and are there comps within, ideally 1 mile of your subject property that give you a good idea of what you think it's going to be worth. And
now, if I could just interrupt for 1 second. So when we're talking about new investors right now. So basically, you're lending at the most 80% of that initial purchase price, and then the 100% of the repair value, or the money that they're investing to fix the property. How does that change with an experienced investor? Can that 80% go up to 90% or ever at 100%?
Yeah. So for an experienced investor, we've got 3 layers: 0 to 2 experience, which we consider new, 3 to 10, which we call experienced, and then 11 or more, which we call very experienced. So we can offer experienced and very experienced borrowers 85% or 90% of the purchase price, and then up to 75% instead of 70% of the after repair value. So
Gotcha.
with the additional experience as the lender, basically what that's saying is we're willing to put more money up, and they're bringing less money. So we're providing more leverage. It's riskier to the lender, and it's extending their ability to do multiple deals at one time with the capital that they have in their pocket.
Gotcha. So we have a question here. Ruth Lyons, she's a Sachs Realty agent. She also is an investor herself, and she's pretty experienced. How does your estimated ARV typically match the market value of completed property? So I guess that comes down to the people that, you want to answer that? The appraisers, and then what's happening in this crazy market, right? Because things are going so far higher than anyone expected.
Right. Yeah, that's a really good question. Before we get there, we actually like to see how close the borrower, who is a real estate investor, is their estimate after repair value is to the appraised value. If they're off significantly, that's a little bit of a yellow flag to us that they may not know that market very well. So we keep a close eye on that as well, but that's different than this question. How close they are, I would say, I don't have exact statistics. Appraisers are typically conservative in the after repair or as completed, which is what the appraiser calls it in the report. They don't like to be off. They don't like to go high on that value. So they're typically conservative. So we do see that they come in at or above, the sale prices have been coming at or above. Now we've been dealing with increasing values for several years now. So depending on how long the project takes, you're getting a little bit of a bump from appreciation due to values increasing across the country, which is helping, the end value come in at or above the appraised ARV.
All right. Well, we appreciate that question, Ruth. If anybody else has questions, send them Kevin's way. So getting back to the process a little bit. So they buy the property, they have some cash, hopefully, right? They are buying a property. So guys, you have to have some money. How much in the qualification process? Let's talk about credit scores and things like that. Mm-hmm. What are you looking for as minimum credit scores from the people that you're underwriting?
Sure. Yeah. So, we can do loans to anyone that has a 650 or higher credit score. If it's under 650 and above 625, we can still do the loan, but we would reduce leverage likely by 5%. And a lot of times, so just to touch on credit score within an LLC, remember that we're looking at 51% of the ownership structure. So that's another way that doing an LLC and working with partners can help. If you have someone that has, for various reasons, lower credit and doesn't qualify, you could bring in someone else that owns at least 10% of the entity and use their credit score. Now they're going to have to be the one that signs the personal guarantee as well, which we can talk about what that means. But there's some flexibility there. And when there's multiple members that make up that 51%, we look at the median score of the highest person, where most banks or other types of institutions will look at the lowest credit score of the group of investors.
So let's take, what are you doing? Averaging the credit scores? So let's take a partnership in an LLC. You have somebody and they get their dad or their uncle or whoever who has, higher than a 650 credit score, but maybe they have a 580 credit score. How are you getting the 51%?
Yeah, so we're going to look at, and a lot of times we just consult the borrower of who needs to own 51%, because remember, behind the scenes, there's probably someone that's putting up the most of the money and that wants most of the profit out of it. But let's say that they don't have good credit. Well, someone else can come in and be the guarantor and own 51% of the entity. That doesn't mean that they need to get 51% of the profits.
So it's just, when you're talking 51%, you're not talking about the partners, you're talking about the one that owns 51% or more of the corporation.
Right.
The company, the LLC, right.
So just to clarify, that we have recourse loans on almost all of our loan products. And recourse means that you're signing a performance guarantee that you will pay interest on that loan. And if you don't, you could be subject to a judgment. And so within the LLC structure, we want a personal guarantee from at least 51% of the ownership of the LLC. Now, it might be a one-person LLC that owns 100% of the LLC. It's very easy. We're just going to underwrite that one person. It could be two people, and it's 51%, 49%. And, we're going to be underwriting the person that owns 51%. And we're going to be telling them to make sure that that person qualifies, has above 650 credit. Mm-hmm. And then it could be a four-person LLC where between two people, they make up 51%. So we're going to pull credit on those two people. If those two people, we pull a tri-merge credit report, which means we get a score from each of the bureaus. And if they've got a 630, a 650, and a 670 from the three bureaus, that one person, we pull the median score, which is the middle score. So we're going to say that their score is 650 and they qualify.
Interesting. And so you're talking about recourse loans where you're tying in a personal guarantor. Do you do non-recourse loans?
Right now, the non-recourse option is on our multifamily bridge product. So that loan is for people who are buying a 5+ unit property. And if the borrower has 700 or higher credit and their net worth is 125% of the loan amounts based on their personal financial statement, we can offer that loan as non-recourse.
5 units or more. And with something like that, is that a higher interest rate that it would be with a recourse loan or a personal guarantee?
No, typically, the reason those are non-recourse is they're typically larger loan sizes with more sophisticated borrowers who are more likely to be able to get access to non-recourse type loans from, banks and other institutions. And that's why, our loan product goes down that path as well.
So what happens when things go wrong? You're estimating, you have a borrower that has the $100,000 purchase, the flip. They're estimating $20,000 in repairs, or $30,000, whatever. They put down their $20,000 to borrow it. You give them the $80,000 or 80%, and you're looking at the after repair value falling in that $140,000 or $150,000 range, and they get into the project and they realize it's much more extensive than what they expected. What happens?
Yeah, no, it's a really good question. I would say typically with a new investor, let's say that they believe it's going to be a $20,000 construction budget. We typically might add a 10-15% contingency on that when we structure the loan. So there would be a little bit of extra money. That 10% on a $20,000 budget is only $2,000. So if they bust through that, unfortunately, they're going to have to come to the plate and pay for any overages to get the project done. We can talk about what happens after that, but that's typically
the guy shows up with the sledgehammer and looking for the borrower or whatever.
No. I mean, ideally they can come up with that money and get it done. In that case, the loan is, let's say we funded that 20 grand and we funded 80 grand up front. We're 100,000 into it as the lender. They're 20,000 into it. There's still a little bit, it's a small loan and a small deal size. There's still some profit there, even if they have to go, $8,000 over budget to get it done. On that loan that I just discussed, that's a typical structure for a property that you're renovating to hold as a rental property. I wouldn't say that's a typical fix and flip loan. There's not a whole lot of profit margin there. So, that is, likely someone that has the funds to cover any overages. And then their exit out of our loan would likely be either Aloha providing them a 30-year fixed loan to pay off that bridge loan that we have out to them, or them going to bank and getting a Fannie Freddie type rental property loan. Typically,
which they have to put in their personal name.
Fannie Freddie, yes. For our loans, it can be personal or stay in the LLC.
Right. So what do you do with how do you prove that someone's not going to live in the house? I mean, what do you have them sign an affidavit? You do a 4-unit, and a lot of people, they want a house hack, and, they want to live in one of the units and rent the other, whether it's the other unit or another 3 units. How do you kind of govern that they're not living there?
Right. Really good question. I would say that brings up a little bit of a side topic of what does a borrower sign when they get a loan. I just refinanced my personal property and I signed 200 pages of bank documents, and I was busy and I didn't look at what I was signing. But for this purpose of this discussion, I think the people on this should know what you sign as a borrower. So you're typically signing a security instrument, which is what gets recorded as a lien against the property. You're typically signing a promissory note, which is the rules of the loan of how much you're paying and when, what interest rate, how long the loan is, what happens if you don't pay, what maturity date is and what happens after maturity. And then on a real estate investor type loan, you're typically going to sign an affidavit of non-owner occupancy, which is basically legally, contractually stating that you're not living in the house. And then likely a business-to-business affidavit, which is basically saying you're doing this loan and it's not a consumer loan, and I'm doing it as a business. And then, there might be additional documents, but the main additional document would be the performance guarantee, which is basically a separate document stating, if we don't pay, the person signing this is personally going to be liable for paying outside of the LLC. So I went into that because it matters to answer that question of, what are they signing up for?
So what happens if they're living in it? They do it anyway.
Yeah. So back to the question at hand, I do not have nationwide non-owner occupancy police knocking on doors.
Right.
So it really comes down to there's a legal contract there. Most of our borrowers don't live in the properties. When we realize they do is typically upon the loan becoming non-performing, which means either they stop paying interest or the loan is past due, and we start to dig into what's going on at that property, and we find we find that out. We don't typically find out otherwise.
Right. Yeah.
Officially, the loan would be in default if we were aware that they were living in the property, and the lender would be able to begin the foreclosure process if they wanted to.
Mm-hmm. Yeah. Well, I mean, we're certainly not encouraging them to break contracts, so guys, don't live in it. don't live in the house that you said you wouldn't live in, and everything will be fine. How about lead paint? Lead paint seems to be a hot topic. There are a lot of lenders that will only lend on the property if it is certified lead free, not lead safe. How about you guys?
Yeah, really good question. I would say, if that's identified in the contracts and we're aware of it, what we're going to want to see is that there's some type of mitigation plans in the construction budget. Same thing, with a foundation issue, various other items like that. If it's identified in the appraisal or otherwise, we're going to want to make sure that there's a budget set aside in that construction budget that we're reviewing to mitigate that.
So you want it gone. You want the properties lead free ultimately.
Yeah. We haven't run across it that often. But what we need it to be is a property. If it's a fix and flip, you're going to be selling it to a retail buyer, someone buying it as their primary residence. So we want to make sure that the property qualifies for that retail buyer to get their financing to buy the property from our borrower.
Yeah, we don't really see where a retail buyer is faced with mitigating or eliminating lead, and that a lead inspection is even necessary. Based on the disclosure that the seller provides, saying, hey, do they know if there's lead paint present, and do they have any reports? But I think the big question comes down to, and where my experience with a lot of the lenders is the fact that when you're having multifamily or tenants renting and they're in a position where there could be lead paint hazards present, what happens is at least here, I don't know about other states, but in Maryland, you can no longer just hide behind an LLC or a corporation to a lead paint claim. So they actually can pierce those corporate veils and go after the ownership for the liability. So I've seen where the lenders are requiring it to be lead free as part of the the renovation process.
Yeah, I would say, to add on to that, be familiar with the potential landmines in your market legally. If that's the case, in Maryland, and that you're buying a property with that issue, it's maybe one that you walk away from.
Do you ever put any? I say this, and you guys are clients of mine, but I'm going to say, do you ever reach out to the agent? I know you get appraisals on all the properties, but do you ever talk to the realtors that are involved in the deals with these borrowers that, and ask them for, their opinion on what the after repair values would be? I mean, any strength in having good agents involved?
Yeah, of course. I would say we love when, a deal comes to us with, their thoughts, a detailed budget, and, a market analysis from their agent. I think that's strong. And we can actually provide that information to the appraiser. Now, they don't always use it and they might pull their own comps, but it can only help, kind of point people in the right direction.
Yeah, I don't know that it helps the appraisers at all. Honestly, what's going on right now, but But I meant as far as you as the lender, do you look, so you've got an appraiser that's saying, hey, the ARV's 250, and you have an agent saying, no, actually the ARV's 280. Does that come into play at all? Or are you sort of bound by what the appraiser says?
No, I mean, that's a good question. What happens when your appraisal doesn't line up with what you believe reality is, or your agent believes reality is? So there's a couple options for us. We can pull together a good analysis, typically from our borrower's agent, explaining, why a comp should get, pulled out of the appraisal, et cetera, et cetera. And we're very happy to do that. So the only problem with that is if it's a purchase and it's on a tight deadline, you're on the appraiser's time frame. So are they going to respond timely to that? And historically, I've seen some adjustment. It usually doesn't get right to where the buyer, borrower, and agent want it to be, but maybe it gets somewhere in the middle. So there's always a chance to kind of fight that value. And we really try to find appraisers that do a lot of volume of ARV appraisals, or so after repair appraisals, or as completed, which is what it's called, the checkbox in the appraisal report, because they're more likely to come up with an accurate value. Some appraisers just do hundreds and thousands of as-is appraisals, and they don't want to put in the extra effort to figure out what the property's worth when it's.
And it is effort. It is definitely effort. And, I find that getting appraisers to do multifamilies quite laborious too. I mean, a lot of them don't want, I've actually had appraisers call me up, find out all the deals of multifamily. Nah, no thanks. I'm licensed to do it, but I don't want to. And so, I guess you guys have sort of sniffed out all the good multifamily appraisers in an area, or you're still in the process of doing that.
Yeah,
say you have all your states covered pretty well.
Yeah, I would say on the single family deals, so 1 to 4 unit condos and townhomes across the country, we feel confident that we can find a appraiser or do that hybrid appraisal and get a report back in a timely fashion. On 5+ unit, specifically maybe 20+ unit, those become a narrative appraisal, which is a different beast, and there's less groups out there. That's a true commercial appraisal that looks at sales and income approach for those properties, which, Todd, I know you're very familiar with. Those don't, with two things, they're more expensive, so don't expect to get one of those for $600 like a single family appraisal. And the typical term time is 4 to 6 weeks. These are commercial appraisers who book up, and there's not significant quantity of them in any market. So we typically can work with, the local group that's local to that market, maybe a smaller independent shop. And then we have relationships with, 4 or 5 of the big national names as well.
So let's talk about the actual repair process a little bit, because a lot of people might not know. Draw schedules, things like that, how they get the money for the repairs, and, there are actual inspections too so there are additional costs. And I just want to kind of run through them a little bit. So we'll kind of take it from the top. What are the costs of obtaining a loan? So you have, are there any points typically with Aloha?
Yeah, sure. So our bridge loans are typically 2 points for the loan origination. And then the borrower typically pays the appraisal fee. We don't have any upcharge on that. We just find, the fastest turnaround time and the best, cost for the borrower. So we do quote that out and try to get, within a couple of days that order signed. And then we typically charge a underwriting document legal fee, kind of all in one. And that's typically about $1,250 at close. And those are our fees. That permanent product has slightly different fees in that you can pay discount points to get a lower rate. But on the bridge loans, it's typically 2 points and then a document.
And just for everybody, define the bridge loan. So you're talking about, when they're buying that distressed property that needs updating and they need cash for fixing that up. And then that kind of goes to more of a permanent. So really like a construction to perm type of loan, right?
Yeah. So when I say bridge, I guess what I mean is a short-term loan, short-term bridge loan. It's a bridge to stabilizing the property is why I say bridge. We do those loans with construction as part of the loan. We can also do them without construction. So, I have a borrower right now that owns well over 300 single family homes in the Denver market. A portion of that portfolio he's owned for 5 to 10 years. So they've appreciated a ton. We just did 69 short-term bridge loans that, the purpose was cash out. So we did cash out at 80% of the current value, created a significant amount of capital for him to go and buy additional single family homes. So he's a real estate agent in Denver, and he is big on appreciation in Denver. And so he's basically, when we met him a year ago, he was buying every single family property in 2 zip codes under 350,000. And then appreciation happened and he started buying everyone under 400. Now he's buying everyone under 450. And he's taking homes that he's owned for a while that have appreciated to create the capital through a cash out refinance to buy additional homes. So in that concept, the reason I was talking about that is there's no construction budget. It's a short-term bridge loan with the purpose of pulling cash out for other investments. And then he will take those properties and put permanent financing on them to stabilize the financing on them.
So did you do that each individual house, or did you kind of wrap those into one loan?
Yeah, good question. In his case, we did them as individual loans. We can also do a blanket loan, which would be, doing all those properties in one loan. There's pros and cons to both methods. One of the pros to doing it as a single property loan is that when you go to pay off that loan, you can just be looking at that one loan. If you have a blanket loan, what usually happens is you have a release provision. And what that means is to do a partial payoff. So let's say you have a 10 property loan. So there's 10 properties linked to one loan and you want to get rid of one property. So you want to sell that one property. There's an allocated loan amount to each of the 10 properties. To pay off that one property, you're going to have to pay 120% of that loan amount to release that property from the loan. So that's what's called a release provision. It ensures that the lenders doesn't end up with, the dumpiest property when you get down to the last couple properties in the portfolio. The result to the borrower is that it makes it a little bit more difficult to unwind that portfolio loan or that blanket loan in portions. So we consulted with him. There was some cost savings to do it as a portfolio loan, but he preferred to do an individual loan per property to be able to move each property into the new financing as needed.
Now, Kevin, everything we're kind of talking about right now is residential. Do you do any commercial lending where, it's actual commercial businesses, retail, office, that type of thing, or mixed use?
We do mixed use. We do mixed use where it's at least 50% residential. And then the other 50% can be any type of commercial. So retail, restaurant, etc.
Can that be owner occupied? So if it's the borrower's business, can that qualify in the commercial space?
It can, as long as the borrower's business is an LLC. So in that case, it's not really owner occupied. If the tenant is a business they run in an LLC, we would consider that non-owner occupied.
Got it.
We touched on doing some true commercial office industrial lending. We got out of it in 2018. We're pretty happy about that as an investment management firm and lender, just with some of the bumps we've seen in the last 12 months. And we're really focused on residential. It's what we do and what we know and what we do well.
You guys have been at it for a while now. You said 2015 you started lending. Obviously nobody anticipated the pandemic, COVID. As a primarily multifamily or residential lender, have you seen any type of, landlords kind of, if their tenants aren't paying, a lot of them are kind of serious hardship right now. Are you experiencing anything in, your portfolio?
We have a little bit. It has not been a significant impact. I would say maybe 4 to 5% of our portfolio requested forbearance through the early part of COVID, and in different forbearance than what banks are offering. I think the banks being federally regulated, they were forced to offer forbearance, meaning you don't have to pay anything. We offered some people, if they qualified, to have a lower interest rate for a set period of time that they could pay back over the following period of time. So that's how we help people out and help them get through the hard times. Most of that has really worked itself out here in the first part of 2021. So we really don't have too much going on as far as COVID hardships. But we feel like we're a fair lender, both on how we look at deals and fund them. We want to work with borrowers that we feel can get the deal done, can execute on it. We want them to either be able to make a profit at the end or spin that property into a rental property and know that will cash flow. So we underwrite to that. And really a super high percentage of our clients are repeat borrowers. We want to work with active real estate investors. So we're not in the business of trying to take people's properties, et cetera. So we made it through pretty unscathed. I would say, our clients, where we needed to be flexible, we were, and luckily most of them have been able to kind of work themselves out of those holes.
So when you talk about 250 million in loans in 2021, a couple of things come to mind. How does that change from 2020? Is that significantly more?
It's very significantly more. I would say it's about double what we did in 2019. And as a business, we've been doubling our loan origination every year since inception. So in 2018, we did 52 million. In 2019, we did 105 million. Right now, we're, close to 50 million with a pretty huge pipeline of loans that we're moving towards closing. So things are looking good out there as far as deals that are profitable, people finding projects that they can add value to. I would say our business, we have about 50% of our clients that are more fix and flip type investors, and the other half would be fixed to rent, where they're really trying to increase the value of the property, so that when they roll that property into permanent financing, they have a minimal amount of capital locked into the property.
Now, depending on who you listen to, they're talking about this bubble, right? This real estate bubble. As somebody that's been in the real estate industry for over 25 years, I've seen, from the construction aspect, I've been in, this is my 32nd year as a contractor, and I've certainly seen how quick things can change. The early 90s was a couple tough years for me. And then certainly when we saw the housing crash in 2008, it's actually started a couple years before that, but we saw how quickly, the tides can turn. Do you have any concerns where, I mean, in your strategies, are you concerned about the fix and flips more than, cash flow properties at this point, like the multifamily, assets? Are you dialing back any, or, what are your thoughts on, because I mean, all across the country, I mean, I've been to Tennessee, I've been to Texas. I've even talked to people in Canada. And everybody sort of seems like they're in the same spot right now, where things are selling in record time for, high prices, way over what we think is the highest, and they're still going higher. But that's falling also on the real estate investor, kind of over what I'm going to say is overpaying right now. And, in a situation where building materials are at all-time high. And, now we're hearing where, I was talking with a guy today, and he was saying that buy water heaters because next year we're not going to have them. My painter that I have apartments that we're painting right now, he's saying he's buying all the paint that, every Sherwin-Williams has in this particular product, and that his paint supplier is telling him, that there's a shortage on the chemical that is being made with the paint. I have appliances that I've ordered, 5-6 weeks ago that are still on back order that were, supposed to be in 4 weeks ago. There's a whole lot going on right now. I mean, what are you guys thinking as lenders? I mean, are you paying, obviously you're paying attention to this.
Yeah. I mean, what we're still seeing, I mean, of course, we look at all the economics here. We see a housing shortage in many, many markets. Nationwide, there's a shortage. We look at each market. And so we look at this monthly as a investment committee. And we're keeping it, we pay attention to values in each zip code that we're lending in. So every time we do a loan, we're looking at, how long is it going to take for this project to get done? The longer the project, the more risk there is that something changes on you. And then we're looking at, what have the values done in that market in the last, 36 months, and where do we think they're going to be, depending on how long that project's going to take. So, we're not too worried about the kind of quick fix and flip type loan where it's a pretty light budget and it's just, reinvigorating the home because it's going to be done in a couple months, unless there's a major shortage of supplies. And you're unlikely to see a huge change in a 2-month period of time, 3-month period of time. We definitely, on bigger, heavy rehab projects, where it's a bigger dollar amount and a bigger project, what we're doing is baking in a longer loan periods because it might take them longer to get the project done as far as getting construction materials, and it could take longer for them to sell the property. And we haven't made any changes to leverage or anything like that, but we are making sure that there's enough profit in percent compared to the deal and dollar amount for our borrowers to be successful in that.
Well,
it's an active, you're right, and something could happen, but in many of these markets, there's really just a shortage. I mean, you can probably talk more in depth than I could, but the days on market are very low right now, which just means that people are eating it up.
We have no foreclosures to speak of hitting, the market. So, I mean, the moratorium on foreclosures is really preventing not saying that we're expecting people to be foreclosed on, but I mean, come on, let's face it. I mean, every year we rely on foreclosures to hit the market. So, that extra inventory is going to be there. Certainly for the last year plus now, we're not seeing any of that inventory. And then I read an article, and I don't, know the exact ins and outs of this. You might even know more than me, but I hear that 30% of the inventory that is out there is being, snatched up by institutional borrowers or buyers, institutional buyers. So, can you shed any insight to that?
Yeah, I mean, in certain markets, the iBuyers are sucking up some of the supply of inventory. It'll be interesting to see as the courts catch up. One avenue for real estate investors to get a good deal is to be buying things from banks' balance sheets, from lenders' balance sheets, from foreclosure auctions, from sheriff sales. We really haven't seen much activity there. We historically have provided lending on those types of transactions, and I haven't seen really more than a handful of those in 16 months or more. So real estate's cyclical. So right now our fix and flip clients are maybe overpaying up front, but then appreciation's kicking in over the life of that loan and the life of the project, and they're getting good exits. At some point in the future, things will change, and then you'll be able to get really good deals, hopefully, and the values won't be as high, but there's still profit there to be made in the value add.
Well, I love your outlook. I mean, anybody that's going to lend $250 million in the next 12 months, I mean, I want to pay attention to, because, I mean, obviously you guys are, you're meeting about this, and, you're definitely keeping your thumb on the pulse. So you also have opportunities, and I just want to touch on it real quick. And guys, all of our information will be in the show notes. Feel free to reach out to Kevin. He'd love to talk to you about your investing goals. People can lend money to you guys as well, right? I mean, you have on your website, you actually have two areas that someone can enter. One is they want to borrow money, and here we go. Joe's pulled it up for us. And then the other is to invest in money. Do you want to just kind of talk briefly on, if somebody has some cash, what are their options with investing in Aloha Capital?
Sure. Yeah, I would say in essence, we run two businesses. So we run a lending business. And so we're providing capital to real estate investors through loans, on fix and flips, fix to hold, et cetera. And the other side of our business is we run an investment fund for accredited investors. And so that's really a pool of capital that we're using to run the lending business. And so as an investor in our fund, the Aloha LTD Income Fund, it's a pooled investment. You own a fraction of the fund, and what's held in the fund is hundreds of loans that we've done. So we're doing 9 to 24 month loans, and they're constantly getting put on our books, our fund's books, and then they get paid off. And so it's really a interesting real estate investment because it's very passive. You're investing into a fund, you fill out some paperwork, you get a monthly statement. You can take a monthly distribution of income or keep the income and have it roll. And it's very diversified, meaning at any given time, our fund might have 200, 400 loans in the portfolio. And so the investors in the fund are getting their portion of income, interest income, that we're collecting on all those loans. It's further diversified in that we lend across the nation. So, you're getting access, to real estate across the country and across different asset types. So some of the loans are on single family fix and flips, and some of them are on multifamily value add, and some of them are, just bridge loans that aren't value add. So there's a really great makeup of the types of properties in there, and you're diversified across all the different borrowers that we're lending to. There's different ways you can invest and be a lender yourself. Many times your money's then going to one borrower and one loan. That's not very diversified, and you're subject to that one person's execution. So the fund has a 6-year track record. It's been open since 2015. The average return is around 9% annually. And there's no lockup period. So you can enter the fund monthly. You can leave quarterly with a 45-day notice. So it's pretty interesting investment opportunity.
Sounds like it, definitely. So, guys, if you have some cash sitting around and you want to diversify a little bit, check out Aloha. Again, all the links would be in our show notes here. Well, Kevin, I tell you, this has been great. Great information tonight. Thank you so much for being on our show.
Todd, I appreciate it. Thank you very much. Happy to answer any other questions. Appreciate the time.
Sounds great. Well, guys, we, like always, appreciate you following along and watching or listening to whatever platform you desire. And if you would, we'd love it if you would check us out and subscribe or follow to whatever platform you are checking us out on. And until next week, guys, thanks for watching.
Thanks.